Okay, so we've covered a lot of terminology so far in Chapter 11. We're going to now get into the actual accounting side of how to record stock transactions, okay? So we're going to look at how to account for common stock, identify a new account title called a paid-in capital account, and discuss how to account for, again, different type of stock transactions. Here we go. We have Hydroslide Inc. issues 2,000 shares of $1 par value common stock. Prepare the journal entry if for A, 1,000 shares are issued for $1 per share, and B, 1,000 shares are issued for $5 per share. Now, this is an academic example, okay? In the real world, a share of stock will never be issued for its par value. As a matter of fact, I'll pull up an actual statement, and what you'll see is that typically par value is going to be like maybe 1 cent, 10 cents, not normally $1. And when stock is issued, it is not going to be issued at its par value amount. So keep that in mind. But from an academic standpoint, for our first example, this stock was issued at its par value amount. If that's the case, kind of light there, I hope you can see that, we're going to debit cash for $1,000. That is the 1,000 shares at $1 per share that was issued, and credit common stock. You will always credit the common stock account at its par value amount. Again, always credit common stock at its par value amount. Now, for the second transaction, which is a bit more realistic, they're saying the other 1,000 shares were issued for $5 per share. Most stock will be issued at a price above its par value. When that takes place, the excess of the issuance price over the par value goes into a new account title called paid in capital in excess of par value. So we issue 1,000 shares at $5 per share. So you'll debit cash for $5,000. Again, you always credit common stock at its par value amount. So it's kind of hard to see. I apologize for being so light. But credit common stock for $1,000. Then the excess goes into an account title called paid in capital in excess of par value that we're going to credit in the amount of $4,000. So once again, debit cash for $5,000, credit common stock at its par value, which is $1 per share times 1,000 shares for $1,000. The excess goes to account title called paid in capital in excess of par value that we're going to credit in the amount of $4,000. Now on the balance sheet, you're going to show common stock based upon its par value amount. So we issued 2,000 shares of common stock. Their par value is $1 a share. So that 2,000 goes in paid in capital. Recall that 1,000 shares were issued at $5. They were issued at a price of $4 above its par value amount. So we're going to multiply the 1,000 shares times $4, and that 4,000 goes to an account called paid in capital in excess of par value. So now the total paid in capital section of the balance sheet, $6,000. Add that to your retained earnings to get total stockholders' equity in the amount of $33,000. Okay. We have the ABC Corporation issues 1,000 shares of $10 par value common stock at $12 per share. What would be the entry to record this transaction? So they're going to issue 1,000 shares of $10 par value common stock at $12 per share. Recall that you will always credit common stock at its par value amount, and if the issuance price is higher than the par value, the difference goes to your paid-in capital in excess account. All right? So if you said the correct response would be letter C, that is correct. You would debit cash for $12,000. From the credit side, credit common stock 10,000, 1,000 shares at its par value, and the difference goes into your paid-in capital in excess account. Okay? Next, we have what's known as preferred stock. Preferred stock. When you have a preferred stockholder, they have certain rights over the common stockholders. However, they will give up other rights. So the preferred stockholders will receive dividends before the common stockholders. And in the case of a liquidation, the preferred stockholders receive assets before the common stockholders. Now, remember I told you before that when a company liquidates, that means they're filing for bankruptcy. Most of the time, they do not have enough to even pay their creditors, let alone pay their stockholders. So yes, this is a right of being a preferred stockholder, but again, most of the time, stockholders are not going to receive any assets when a company is liquidated. Their only recourse is to sell their stock to try to recoup their investment. Now, if you are a preferred stockholder, you do not have the right to vote. So you must determine what's more important to you. Would I rather receive dividends before the common stockholders? Is that more important to me? Or do I want to have a say-so in who become member of the board of directors? So remember, if you're buying stock, know what the rights are. So if you're buying common stock, it has certain rights. If you're buying preferred stock, it's going to have certain rights. Now, just like with common stock, preferred stock will also have a par value. So when preferred stock is issued at a price above its par value, the excess goes to a paid-in capital account in excess of par value, but it's a preferred stock rather than common stock. For example, Stein Corporation issues 10,000 shares of preferred stock with a $10 par value. They were issued for $12 in cash. So again, why is this so light? I don't know. So the cash, you would debit $120,000. That's 10,000 shares times $12 per share. Credit preferred stock at its par value, $10 times 10,000 shares, and the difference goes into your paid-in capital in excess account, but notice that it says preferred stock rather than common stock. So from an accounting standpoint, we treat common stock, preferred stock the same. You always credit common stock or preferred stock at its par value amount, and any excess goes into your paid-in capital in excess account. Okay? Another example, we have Cayman Corporation begin operations on March 1st by issuing 1,000 shares of $1 par value common stock for cash at $12 per share. Then on March 28th, they issued 1,500 shares of $10 par value stock at $30 per share. So once again, you will always debit cash at the issuance price, always credit common or preferred stock at its par value amount, and if there's a difference, it goes to your paid-in capital in excess account. All right? So now I want to be dark. Okay? So we'll debit cash for $1.2 million. 100,000 shares times $12. Credit common stock for 100,000, which is as par value, $1 per share times 100,000 shares, and then the excess goes into the paid-in capital and excess account common stock for $1.1 million. Now, this transaction is probably a little bit more realistic, where again, the issuance price would typically be a lot higher than the par value. But again, debit cash, $1.2 million, credit common stock, $100,000. The excess goes to the paid-in capital in excess account. For the second transaction, 1,500 shares, $30 per share, debit cash, $45,000. We're going to credit preferred stock at its par value amount of $15,000. That's $10 per share times 1,500 shares. And then the excess goes into the paid-in capital excess account preferred stock for $30,000. So always debit cash at the issuance price. Always credit common or preferred stock at its par value amount, and any excess goes into your paid-in capital in excess account. Okay? We now have a topic known as treasury stock. Treasury stock is when a company buys back their own stock that was initially issued. That is known as treasury stock. So again, when a company buys back its own stock that was issued previously, that is known as treasury stock. Treasury stock is going to reduce the total of the stockholders' equity section because stock that was issued or sold has now been bought back by the company. So when you have treasury stock, that's going to reduce the total of your stockholders' equity section. Perhaps you're saying, why would a company buy back their own stock? It could be for a variety of different reasons. One reason could be because they have some type of stock option plan going where they're going to give their stockholders a number we call stock options. Stock options allow the employees, typically at a certain level, to buy stock at a set price. Okay? So a company may buy back their own stock to even give to the employees as a form of compensation. It could be for a bonus, things of that nature. Another reason could be to increase trading. Increase trading. Yes, increase trading. Some investors buy stock based upon the volume. They'll say, wow, this company sold 10 million shares of stock today. I should buy some. Well, they don't know that the company bought back those 10 million shares of their own stock because they understand that there are certain investors who will acquire stock just because of the volume of stock they were traded. That's not a good reason for buying stock, people. Another reason to have additional shares available for use and acquired other companies. So when companies sometimes buy other companies, they do that by issuing them shares of stock in their own corporation. And so they may decide to buy their stock back because they're planning to acquire another company and they're going to use their stock as part of the acquisition process. And last, to increase earnings per share. So when there's less shares of stock outstanding, which we talked more about, that is going to increase the earnings per share of the corporation, and that actually is a good thing. And another one, which is more infrequent, is to eliminate what we call a hostile shareholders. And I'm going to tell you all about that after we conclude our Chapter 11 video. So you got to come back for the last one, okay? You coming back? You promise? Okay.